Welcome to The Explainer. Today we are diving into a really bold prediction from one of Bitcoin's biggest champions, Michael Saylor. He's saying that the absolute giants of traditional finance are about to jump into Bitcoin in a huge way. So let's break down exactly what he's seeing on the horizon. So here it is, the core of the prediction. Saylor is claiming that in just a couple of years, the biggest banks in the US won't just be okay with Bitcoin. No, they'll be actively buying it, holding it for their customers, and, this is the real kicker, using it as collateral to issue loans. That would be an absolute game changer. And look, this isn't just about getting a stamp of approval from the big guys. Saylor is directly connecting this wave of institutional adoption to a massive potential price impact. He's forecasting a price target of up to $170,000 per Bitcoin by 2026, all driven by this incredible new level of demand and utility. Okay, a price target like that sounds pretty wild, right? So you have to ask, what makes this prediction even remotely credible right now? I mean, for years, this kind of talk was just, well, talk. But recently, a couple of major regulatory and accounting roadblocks have been demolished, basically paving a brand new superhighway for institutional finance to drive right onto. You have to understand, for the longest time, the actual rulebook made it completely impractical. I mean, almost impossible for a major bank to hold Bitcoin, either for itself or for its customers. From a compliance point of view, it was all risk and no reward. But that has just fundamentally changed. What's so fascinating here is just how clear the before and after is. So roadblock number one, this thing called SAB 121, forced banks to put a customer's Bitcoin on their own books as a liability. That was a total non-starter. Well, that's gone now. The second thing was the crazy accounting model. Banks could only report when Bitcoin's value went down. They couldn't report it going up unless they sold. It gave this completely distorted picture. Now, with fair value accounting, they can finally report its true market price, gains and losses included. This slide really just sums it all up. By getting rid of these two, honestly, critical roadblocks, the path for banks is suddenly wide open. They finally have the green light from an accounting and regulatory standpoint to start building real Bitcoin products for their clients. The foundation has officially been laid. So the really crucial point here isn't just about banks adding a buy Bitcoin button to their app. The real revolution that Saylor is talking about is using Bitcoin as an actual financial tool, specifically as collateral. This is where things get really interesting and how we could see a totally new kind of credit system emerge. And this is the multi-trillion-dollar question. Banks are, by their very nature, super conservative. They hate lending against assets where the value bounces around all over the place. So how in the world do you convince them that Bitcoin is a safe enough bet to use as collateral? Well, Saylor's actually proposed a specific blueprint to solve this exact problem. See, he's not trying to jam a square peg into a round hole. Instead, he's proposing a whole new framework he calls the BTC rating. It's designed from the ground up to give banks the statistical confidence they need to get comfortable. It basically throws out old-school debt metrics and replaces them with ones made specifically for a world where Bitcoin is collateral. And here's the logic behind it. First, you figure out the BTC rating. Pretty simple. Does a company hold, say, 5 times more Bitcoin than it owes in debt? Great, that's a 5x rating. Then you use volatility models to calculate the statistical risk of that coverage ever dropping below a 1-to-1 ratio. And from that risk assessment, you can generate a credit score that a traditional bank can actually understand, comparing it to things they already know, like investment-grade bonds. Now, this isn't just some theory being tossed around at crypto conferences. According to the leadership at MicroStrategy, these conversations aren't just hypothetical. They are happening right now, with the biggest names in U.S. banking. Yeah, MicroStrategy's CEO Fong Li actually said that the big players are done watching from the sidelines. They've seen all this capital flowing to crypto-native companies, and they're now actively trying to close what they see as a huge Bitcoin product gap that they just can't afford to ignore anymore. And let's be crystal clear, we are not talking about small, niche players here. The reports are that these discussions are happening with the absolute pillars of the American financial system. I mean, these are household names. The very fact that these institutions are seriously exploring Bitcoin services, well, that signals a massive, massive shift in thinking. And the roadmap they're apparently discussing makes perfect sense. You start with the basics, right? You offer custody so your clients don't have to take their money somewhere else. Then you start lending against that collateral you're holding. And the final piece of the puzzle is to create sophisticated, tradable Bitcoin-backed securities that look and feel just like the products that traditional investors are already used to. So what's the big picture? What does it all mean? If Saylor's right, and the big banks really do get into the Bitcoin business, what would the impact be? Not just on the price, but on the entire market. Well, the most obvious impact would be on the price. I mean, this institutional wave wouldn't just bring in a few $1,000,000. We're talking about the potential for billions, maybe even trillions of dollars in new capital as these banks open the floodgates for their massive client bases. This is the demand shock that's really behind Saylor's ambitious price target. But, maybe the more important long-term change would be to Bitcoin's actual personality. The big takeaway here is that as Bitcoin becomes a mainstream bank asset, something held on balance sheets and used as prime collateral, its famous volatility could actually start to go down. It might start behaving less like a crazy speculative startup and more like a stable, mature part of the entire global financial system. Hey, if you found this breakdown helpful, do us a huge favor and hit those like, share, and subscribe buttons for our channel, Crypto Explorer 24/7. Your support really does help us keep breaking down these complex topics so you can stay ahead of the game. And we'll just leave you with that final thought to chew on. If the biggest banks in the world really do start treating Bitcoin as digital property, as collateral for credit, what does that actually mean for the future of money itself? Something to think about. Thanks for watching. Okay, so check this out. Gold and silver. They're hitting highs we haven't seen in years. And at the exact same time, Bitcoin is just soaring. Now, this is not a coincidence. This is a massive global search for safety. But for us in the crypto space, this raises a multi-trillion-dollar question. After Bitcoin gets its run, where does all that capital flow next? Let's follow the money. All right, so in this breakdown, we're going to connect the dots. We'll kick things off with the big global forces pushing old school assets to record highs. Then we'll see how that exact same energy is fueling Bitcoin's surge. And finally, we'll dive headfirst into the core debate. Will all this cash rotate and kick off a legendary altcoin season, or have the rules of the game completely changed for good? To really get what's happening in crypto right now, we've actually got to zoom out and look outside of it. We need to understand the powerful macroeconomic forces that are pushing investors all over the world to find a safe place to park their cash. So what you're seeing here are three key drivers pushing money into safe havens, and they have direct parallels in crypto. First up, geopolitical turmoil is creating a massive flight to safety. Next, the idea that central banks are going to cut interest rates makes assets that don't pay a yield, like gold and silver, look a lot more attractive. And third, there's a huge supply shortage. Demand is just crushing supply. Keep these three things in your back pocket. They are absolutely critical. And this hunt for a safe haven, well, the impact has been absolutely massive. I mean, just look at Bitcoin. Over the past year, it surged, get this, 158%. That is not just a number on a screen. It represents a tidal wave of capital moving into the digital world, searching for a home outside the traditional financial system. So with all that uncertainty floating around, the conversation is starting to shift from physical gold to, well, digital gold. Investors are now seriously positioning Bitcoin as the modern answer to the very same problems that are driving that huge rally in precious metals. I mean, for thousands of years, gold has been the undisputed king of storing value, with a market cap over $27 trillion. Bitcoin is the new kid on the block. It's digital, it's only 16 years old, and its market cap is just over $2 trillion. Now, for the big institutional investors, that huge gap doesn't just show that Bitcoin is young, it signals incredible room for growth, making it a powerful alternative or even a complement to gold. Okay, and this is the absolute game changer. The entire structure of the market has fundamentally changed. The launch of those spot Bitcoin ETFs created a regulated, super accessible fire hose for institutional capital. We're talking more than $60 billion in net inflows flooding into Bitcoin. This created a kind of structural demand that just flat out didn't exist in previous cycles. And this is exactly where the old crypto playbook gets tossed right out the window. This new institutional money, it plays by different rules. As one Reddit user so eloquently put it, the money flowing in from giants like BlackRock isn't here to gamble on the next meme coin. It's a long-term Bitcoin-only investment, and that creates a huge barrier for that traditional crypto cycle we all know. Which brings us right to the heart of it all, the great debate. Will the historic amount of capital that's now locked into Bitcoin spill over into the riskier, but potentially way more rewarding world of altcoins? Or are we in a completely new paradigm? let's just take a quick look at the history here, because the pattern is pretty clear. It all centers on one key metric: Bitcoin dominance. That's just Bitcoin's slice of the total crypto market pie. Back in 2017, dominance collapsed, and that money poured into alts, leading to insane returns. In 2021, boom, it happened again, fueling the rise of DeFi and NFTs. And now, well, here we are. Dominance peaked, and it's starting to dip again. If history is any guide, this is the exact moment the fireworks are supposed to begin. This is the question on literally everyone's mind in crypto right now. Are we on the verge of another one of those explosive, broad-based altcoin rallies that could generate life-changing wealth, or have the rules of the game been totally rewritten from the ground up? All right, let's break it down. You've got two camps. The bulls believe history is going to rhyme. They're looking at falling Bitcoin dominance and upcoming rate cuts, and they see the perfect rocket fuel for riskier altcoins. The bears, though, they're saying no way. This time is different. They argue that institutional ETF money is sticky. It's not going anywhere. Plus, everyday retail investors are getting squeezed by inflation. They believe these new ETFs have created a soft floor for Bitcoin, preventing the kind of dominance collapse needed for a real classic alt season. So, where does that leave us? Bull case, bear case, who's right? Well, the most likely answer isn't a simple yes or no. Instead, what we're probably seeing is an evolution of the market. A new, maybe more mature crypto playbook taking shape. Analysts are basically looking at three potential futures. There's a 30% chance of a crypto winter, where Bitcoin just wins and alts slowly bleed out. There's a 20% chance of a mega cycle. That's the dream scenario, where everything goes parabolic. But the most likely outcome, with a 50% probability, is what's being called the grind. This isn't the free-for-all of the past, but a slower, more selective, and smarter rotation of capital into only the highest quality projects. So if we are in this grind scenario, what does that actually look like? Well, capital is expected to flow in a pretty clear sequence. It starts with Bitcoin. Check, that's complete. We're now in the phase where Ethereum starts to catch up. From there, money should rotate into other large established altcoins. Only after that will we see the speculative narratives like AI and gaming really take off, followed by that final euphoric meme coin mania that usually signals the market top. Okay, so how do you actually track this phenomenon for yourself? Instead of relying on gut feelings or hype you see on social media, there are specific data-driven metrics you can watch to see if this rotation is really happening. Here's your dashboard. This is what you need to be watching. Keep an eye on Bitcoin dominance. A sustained break below 55% is a huge green light for alt season. Watch the ETH/BTC ratio. A move above 0.04 signals Ethereum is taking the lead, and that's usually bullish for all alts. And finally, the altcoin season index. If that thing gets above 75, it is officially on. These numbers, not the narratives, will tell you where the capital is actually flowing. And this brings us to the final crucial question. What we're witnessing here is a battle between old money and new tech, between physical scarcity and digital scarcity. This whole massive capital rotation is forcing everyone to redefine what a store of value truly means in a digital age. To explore more questions just like this, make sure to hit that like button, share this, and subscribe to our channel, Crypto Explorer 24/7, for more deep dives. All right, let's dive right in. We're going to talk about something pretty wild today. Why MicroStrategy's collapse could be the next big black swan event for crypto, maybe as soon as 2026. This is a big one, folks. Okay, look at this number. Just let it sink in for a second. 671,268. What is that? Well, it's not some random stat. That is the insane amount of Bitcoin that one single company holds. To put that into perspective for you, that's more than 3.2% of all the Bitcoin currently out there. Think about that. One company has managed to scoop up a huge slice of the entire pie. They've become, kind of quietly, one of the biggest players in the whole game. And that leads us to the terrifying question we're going to explore today. What on earth happens if they're forced to sell all of it, all at once? Okay, Section 1, the Great Bitcoin Gamble. We're going to look at how one company basically turned itself into a massive leveraged bet on Bitcoin. You see, to really get a handle on the risk here, you've got to understand how they even got to this point. I mean, MicroStrategy, they used to just be a software company, right? But then they did something, well, something completely unprecedented. And the sheer scale of this change is just mind-blowing. Look at this. Their core software business, it pulls in about $460 million a year. Not bad, right? A solid business. But then you look at their Bitcoin bet. We're talking $60 billion in assets. It's not even close. So you got to ask, are they really a software company anymore? Or are they a Bitcoin fund that just happens to have a software business on the side? And this quote, this really just says it all, doesn't it? More than 95% of its valuation hinges on the price of Bitcoin. 95%. Their entire company's fate, its rise and its fall, is completely changed to one single, super volatile asset. And listen, this isn't just some what-if scenario for the future. The market is already showing signs of being nervous. Right now, the company's stock is actually worth less than the Bitcoin it holds. Think about that. That gap, that discount, that's basically Wall Street screaming that they're scared. They're worried about the mountain of debt they used to buy all this Bitcoin. Which brings us to our next section, a high-stakes debt game. We're talking about the massive leverage behind this Bitcoin mountain. So you're probably wondering, how in the world did they buy $60 billion worth of Bitcoin? Was it all profit? Nope, not even close. They did it with debt, a ton of debt. Just look at these numbers. The company is sitting on over $15 billion in liabilities. That's mainly convertible debt and preferred stock. What does that mean in plain English? It means they borrowed a lot. This isn't just a bet. It's a super leveraged, high-risk, all-in kind of bet. And you know, that debt isn't free. It comes with a massive price tag. Every single year, MicroStrategy has to come up with almost $780 million in cold, hard cash just to pay the interest and dividends. It's like a giant bill that comes due every year and they absolutely have to pay. Now, to be fair, they're not totally unprepared. They do have a safety net, a cash buffer of about $2.2 billion. That's enough to cover their payments for maybe 2 years. But, and this is a huge but, that safety net is super fragile. If the price of Bitcoin tanks or if the market gets tight and they can't raise more cash, poof, that buffer could disappear way faster than anyone thinks. So, this all sounds pretty risky, right? The big question is, when could it all collapse? Let's talk about the specific triggers, the things that could actually kick off a meltdown. Okay, so here's how it could play out, like a set of dominoes just waiting to be tipped over. First, imagine Bitcoin's price drops and stays below, say, $50,000. Okay, domino 1. That pushes the company's value below its total debt. Domino 2. Suddenly, the people who lent the money get really nervous, and their ability to get more cash just dries up. Domino 3. And that's when they face a nightmare choice. Start dumping their Bitcoin on the market to get cash or just go into default. Game over. So what's the magic number? The absolute point of no return? Well, the analysis points to around $13,000. If Bitcoin stays below that for a while, we could be looking at total insolvency. Now, I know what you're thinking. That sounds impossibly low right now. But you have to remember, Bitcoin has crashed 70, even 80% before. It's happened. It's not out of the realm of possibility. So what are the actual odds of this nightmare scenario playing out? Well, the estimate is somewhere between a 10 and 20% chance of it happening in 2026. Now, yeah, that means there's an 80 to 90% chance they dodge the bullet, but a 10 or 20% chance, that's like a 1 in 5 shot of a massive market-breaking event. That's a risk you just can't sweep under the rug. All right, let's put this in a context. Could this actually be worse than the FTX crash? We're going to look at why this might be a totally different and maybe even more direct kind of catastrophe for crypto. And this chart really breaks it down perfectly. Look, the FTX collapse, that was all about fraud and counterparty risk, right? You trusted a bad guy with your money and poof, it was gone. The result was a domino effect of bankruptcies. A MicroStrategy collapse is something else entirely. It's not about trust. It's about a tsunami of Bitcoin supply suddenly flooding the market. A pure, raw supply shock. Just try to picture that for a second. A forced sale, dumping over 3% of all the Bitcoin in existence onto the market, all at once. The sell pressure would be absolutely brutal. We could see a price collapse that makes other crashes look small. This isn't just about one company going under. It's a direct hit on the price of Bitcoin itself. Which brings us right back to the beginning and to this one critical question. Knowing there's a real, non-zero, 10 to 20% chance of this happening, maybe in just a couple of years, is the crypto market, are we really prepared for that kind of shock? Whew, a lot to think about, right? If you found this deep dive valuable and you want us to keep digging into these huge topics, do us a favor, hit that like button, share this with someone who needs to see it, and definitely subscribe to Crypto Explorer 24/7. Thanks for tuning in.